what's the sentiment like here in Asia? I mean, if you take a look at where U.S. stocks ended at a new record, but investors here are pretty wavering.
No, thanks very much for having me on the program. It's great to see both of you again. So look, I think we have to take a step back, and the conversation is the same one that we always start off with, which is what is in the price and what is reality looking like moving forward. From a what's in the price perspective, we have to recognize that emerging markets have underperformed very significantly on a year-to-date basis, with the sole exception of India, which has been really a core outperformer. We are turning more cautious on that market on a go-forward basis, so I'm curious to hear what your next guest has to say on that topic. But for the rest of emerging markets, it has not been a particularly good year, so there's not that much in the price. Then the question is, what is reality looking like? And I think all eyes have to be on China here. The JPMorgan argument is that it's very much a tale of two halves. I think there's widespread recognition that first half, in particular fiscal policy, was too tight. You saw almost a 1.5% fiscal drag off the back of a slowdown in government expenditures. You had over a percentage point additional drag from reduced borrowing at the local government level. And I think that there's widespread recognition that that was too tight for the overall economy. The R cut that you saw in July was the first indication of that. One really interesting thing to watch for China for the second half, government receipts are coming in over double what the Chinese government has budgeted. They budgeted an 8% year-on-year increase. We're actually running over 20% on a year-on-year basis. Why does that matter? We could start to see a significant push of funds into Chinese households, which we think could be very positive for China consumption as we start to look into the second half. That's been a key drag on the overall economy and on the overall stock market. And again, is a significant shift that we're looking at as we look into the second half of this year.
James, what's also interesting is that the PBOC is showing a willingness to add stimulus at a time when the Fed is beginning to start tapering. What opportunities do you see emerging from that divergence?
It's a great question. And again, it falls into the overall theme of China being very much a tale of two halves. This recognition that the first half policy, both monetary as well as fiscal, was too tight. You're seeing monetary statements coming out of the PBOC, fiscal statements coming out of the government, which start to support a more optimistic outlook for the second half, in particular in cyclicals and infrastructure as we start to see government expenditure, in particular in the consumption space, as we just discussed, as you start to potentially see fund transfer to Chinese households in a very significant way. So we think those are exciting opportunities from a broader investor perspective. And again, your point regarding the US versus China, we have to recognize emerging markets have significantly underperformed. Again, the key exception there has been India, which sets us up for a brighter second half, given U.S. outperformance in the first half.
James, we've seen also the regulatory overhang, regulatory moves, as well as we see more of a. I'm going to ask you this question. In fact, has there been, in your view, a meaningful ideological shift out of Beijing? And how does that play out for an investor?
So we've seen the Chinese Communist Party as well as Xi Jinping talk about this concept of common prosperity actually for a number of years now. And we're starting to see policies put into place to start to bring that to bear within the overall economic setting. And so to some degree, we would argue some of these policies should not be a surprise. Now, the extent of some of them clearly took the market by surprise, and we're seeing that in the share price volatility that we've seen on a year-to-date basis. I think what we're seeing now, both in commentary out of the government as well as in share price action, is the market has largely digested at least the current stage of regulatory intervention. You're starting to see a bottom form in some of these names. We would suggest that investors to continue to focus on the sectors that the government is actively supporting. And so instead of the platforms, we would be looking instead at sectors, as an example, software as a service, where the government is very supportive. You are seeing supportive policies on a go-forward basis. And so investing in line with some of the policy priorities that we see coming out of the party and the central government, we think are key priorities for investors.
Yeah, look at national champions. But again, there are people which are running scared at the moment, and some have even described China as becoming uninvestable. But aside from that, people are looking elsewhere, looking at emerging markets. And you talked about India and how it's it's outperformed. The thing is that what does that mean for you? Is that, I think that you're becoming more cautious on India. Is it because it's run up too far too fast?
So first, let's deal with the embedded first question that you asked, which is some of the knock-on impacts on regional markets off the back of the regulatory push in China. And one of the key things that we would really highlight is the significant pickup in investor interest in ASEAN and Indian internet stocks. We have seen that play out in a very significant way. We are continuing to invest in more coverage of those spaces in both ASEAN as well as India. And we think that that will be a significant theme over the course of the next couple of years, and you will see fund flow out of China, in particular some of the larger platforms, and into some of these internet names in the rest of Asia, really for the first time in a very structural way. And we're very excited about that opportunity, certainly from a research perspective. India is somewhat idiosyncratic. It is the only significant outperformer amongst emerging markets, outperforming by about 18% on a year-to-date basis. We've recently published research which illustrates that the rate of change in India from an earnings revision perspective is significantly slowing. We do think the same will be true of economic growth. And so we are turning more cautious on the India market, particularly on a relative basis. And if the assumption is that the Chinese economy is going to pick up steam as we move through the second half, you could start to see a rotational trade out of India and into China.